Mortgage rates are the interest you pay to borrow money for a home. Higher rates mean higher monthly payments because of accrued interest, which costs you more over the life of a loan. The Federal Reserve sets short-term interest rates, which influence how much you owe for things like credit cards and car loans. But according to experts, mortgage rates do not follow the Fed. Instead, they follow the 10-year Treasury, which has to do with U.S. government bonds. Right now, the bond market is nervous about inflation, so even with the Fed's recent interest rate cut in December, mortgage rates didn't budge. Our Get the Facts data team dug into the numbers to show us how mortgages have changed over the last decade. Rates remain high, hovering an average of 6% this year. The lowest rates have been in the last decade and came during the COVID pandemic, when they bottomed out at 2.65% in January of 2021. But mortgage rates have hovered around 3 to 4% until the start of 2022, when they surpassed 5% and haven't dropped below 6% since September 2022. And these high rates can be painful when buying a home. Our Get the Facts data team found the most expensive mortgages were in places like Santa Clara, San Mateo, and Marin counties, all in California. But Nantucket County in Massachusetts tops the list, with mortgages averaging nearly $10,000 in 2025. The least expensive are mostly in the South or Midwest, like Todd County, South Dakota, or Stewart County, Georgia, where an average mortgage is over $300. If you're trying to buy a home, experts tell our data team there are 3 barriers right now: those high mortgage rates, high home prices, and buyers just not wanting to buy a house right now due to other levels of uncertainty. If you're curious with how your monthly mortgage rate has changed, our Get the Facts data team created a tool on our website. You just plug in your county and it calculates how much more or less you're paying compared to 10 years ago. Reporting in Washington, I'm Amy Lou.